Greetings and thank you for joining me at FutureMoneyTrends.com. I'm here with legendary economist, investor, David Morgan. He was the first on the silver scene. Many people who search the word silver or look for silver or natural resource stocks in general may come across the Morgan Report or sylvan-investor.com. We're very pleased to have David with us today. David, thanks so much for joining us.
Daniel, thank you.
David, we're currently in the middle of the month of May. Silver is just dropping below 28 as we speak. Where are we in the silver market?
Well, we're hitting near new lows as far as this recent run-up from last year. About a year ago, we were approaching the $48 level. We peaked right before May 1st. Now we're in the middle of May, a year and 2 weeks later. And we're under the $30 level. And a lot of people probably from, let's say, February, March, a year ago, watching it go from the $26 level all the way to 48, probably would never bet that they'd be, seeing silver under $30 now, but that's the case. For a bottom, it's really hard to bottom call or top call. I've done as well, I think, as anybody in the industry. That doesn't mean I'm right 100% of the time. I said 28 is about what I'm looking for. We're there today. I also said that we expect to perhaps see a spike low. Silver is notorious for spike highs and spike lows. We've already had two spike lows in silver around the $26 level, a bit above 26, but 26 and change. And in both instances, silver traded there for very few trades and it bounced right back up to close well above 26 on those given trading days. If it were to happen a third time and it had the same reaction, in other words, it got to 26 and change, say 26.30 or something like that, and had just a few trades and popped right back up and closed at say 27.30 or along those lines, I would be convinced then, but probably 90% probability that that's it, and silver is going to start moving up. It might not be rapidly, but we've seen the bottom. On the other hand, you have to account for the possibility that it could breach the 26.00 level and keep going down. I don't see that, but I don't rule it out. Also, when I look at it, I look at gold. Gold looks like the 1550 level will hold. We're in that area right now, a bit below it. I haven't seen the close yet for today. But as long as we're in this range here and gold holds, then I think silver will hold as well.
Now, you talked about the spikes. In 2008, we saw 21 to 9, and then we recently saw, like you talked about May, and then I think it was September, December. You would know, but anyway, we have seen the spikes, but this is different. This is just kind of going down 50 cents a day, 10 cents a day, but it's been consistent for past week and a half, 2 weeks. What is the catalyst? Why is silver going down right now?
Well, all markets move on buying and selling pressure, as you know. And right now, summer is notoriously the doldrums for the metals markets. There's several reasons. Primarily, the European traders take long vacations. And also, when you have a market that's gotten over-amped like silver did a year ago, it takes time to back and fill and consolidate and build a new base. And the other problems are that people expect silver or gold to do something under the current economic conditions, and they're not. So they become disappointed, they become what's called weak sisters or weak hands, and they sell onto the market. Let's take a real quick hypothetical example. Somebody that saw silver move from 26 to 35 and said, geez, I've got to get silver. And they bought it at 35 and they didn't hedge or whatever, so they watched it go all the way to 48. They watched it hang around the $35 level and it stood there for quite some time. And now it's under that, now they're disappointed they might sell back in the market. I think I coined a phrase called, during these long consolidations, they'll either scare you out or wear you out. And we've seen both during this consolidation. Some very large consolidations for long periods of time, this kind of wears you out. We've also seen these very rapid moves down that will scare you out. Specifically that one that was on February 29th, when Bernanke and Ron Paul had a little discussion. I think I made a video out of it, Brother John F. did, and some others, talking about what really took place when you're selling, 550 million ounces of silver on paper to drive the price down $2.50. That's a scare you out move.
Yeah.
Those are really, especially from leverage. Even if you're not, it's a scary move. So that's what happens in the silver market. It's easy to push the market around both directions, up and down.
Now, on the mining equities front, investors for years have sought safety in buying these companies that have the resources in the ground that might be producing, but not only have we not been rewarded, but we've been 100% about the economy, and we have just been whipped. And it's very frustrating because for me personally, I have a lot of mining stocks, and I'm sure you do too. You buy the mining stocks, and then or you convince your friends to buy the mining stocks, and here the Dow is at 13,000 or near 13,000, and the mining stocks are down 50%. What is going on with with the mining industry?
Well, there's a couple of things in my view. One is that the large money that used to go in the mining sector hasn't for years with the advent of the ETFs. So any fund manager or anybody that manages money, pension fund, anything along those lines, or even large investors for that matter, are not going to take the risk of a mining company that has potential political problems, a flooding problem, a labor strike, ore grade that deteriorates, new tax regimes to fall under, perhaps a nationalization issue. I mean, all of these things that surround the mining issues don't happen when you own an exchange-traded fund. The reason all of that money used to go in the mining stocks is by law, these equity fund managers can only buy equities. They cannot buy the commodity. But the ETF circumvented that, so you can actually buy a physical commodity even though you're technically buying a stock. So all these stock fund manager types are buying the ETFs. So that's a lot of pool of money that doesn't go into the mining equities. The second thing is that the basis for the mining companies themselves have increasing costs because of labor and inflation, even though we don't have any, right? And other issues. In other words, exploration, even building a mill, mining is a tough business, and it's a very capital-intensive business. So even in a good mine that is economic, it gets built out. Well, things change. Maybe the grade isn't as good. Maybe there's a new tax issue. Maybe there's something else. So it adds on to the economic viability of the company. That's not the across-the-board example. That's an example. And basically, it boils down to demand for those equities, and demand just isn't there right now. Again, it's the scare you out of worry. I don't want to repeat myself too much, but these mining stocks have underperformed the metal so drastically that we are really, in my view, at a very big buying opportunity. I got one of my subscribers that recently sent me the old adage, and I was probably one of the first, I think, to talk about sell in May and go away. The adage really was sell in May and come back after Labor Day. And that works a lot of the time. And last year it worked perfectly. If you would have sold everything when I put the sell signal on the trading portion of our portfolio at $48 silver and held that money through to Labor Day, you've probably done pretty good, even though we're down from there. But that was a nice time to be in cash, or at least part of your position in cash. This time, no, you don't want to sell in May because you're selling at a low. Maybe it's going a little bit lower, but you don't want to sell now. It's too late. In fact, really, you've either been buying into this low that's been taking longer than we would like, or you've been staying in cash for a little bit of both. But it's not the time to have fear and sell back, but that's what happens in markets.